The overall story is Houston is in relatively strong position. Oh, you can't hear me? That's a blessing.
Can't hear.
Can't hear? Can you hear? Hello? Can't hear?
You're on.
Okay, I'll yell.
That's better.
That's better?
Yeah.
Okay, so a lot of the same stuff, I will flip through the macroeconomic stuff very quickly. The story for office is basically the same as industrial, and what we can say is that the bottom is behind us, but the next peak is outside visual range. It's hard to predict when it's really going to spike up again. I was hoping to be able to study Texas job growth and look at what jobs were actually landed in Houston and translate that into office space absorption in different submarkets. I thought that would be an exciting thing to talk about. But when I realized that Houston only received 4% of the Texas jobs, there wasn't much of a story to tell. So, like I said, the bottom is behind us and we're headed the right direction. Absorption was actually positive for the first time in 4 quarters. Modestly positive, but positive. And so the overall outlook is a steady improvement into 2011. Houston, related to its peer cities, is in strong position related to vacancy. So we're below the national average.
So basically, if you can see DFW on the far right side of this graph, looks like it's in very bad shape at 18% vacancy. I don't think it's going to stay there for very long because a lot of the Texas job growth went to Dallas. Okay, so look at the position index for Houston. You'll notice that Houston is on the positive side of the correction-contraction phase. You see Houston in the middle of the graph here. We actually do have positive job growth. It's modest, and you'll notice, like I mentioned, DFW had the majority of the Texas job growth. Rig count, we've talked about already this morning. It's in healthy position. This job growth forecast, I think, is ambitious. I really don't think we're going to see serious improvement or meaningful improvement until 2012. There will be improvement, but it'll be modest. Relative to the rest of the nation, Houston at 8% unemployment isn't bad. We like to highlight things like this when there's not much more positive to say. This is the chart that I really studied, and I was a little disappointed. The Texas job growth is across the top. You can see 172,000 jobs, and as Welcome already mentioned, 6,200 jobs came to Houston. I thought it was fascinating that the highest growing sector, the professional business services sector, was the greatest gain in Texas, but it was actually a loss in Houston. And based on this chart, if you guys can find a way to get miners and loggers to take office space, I will pay you a lot of money. Okay, macroeconomics here. Vacancy is down. That's good. Absorption is up modestly. That's good. Lease rates are stabilizing. Market by market, building by building, there's a different story. But overall, they're stabilizing. New construction is down. This is good for our future. And job growth, of course, is up. Okay, this graph shows vacancy, the wave graph going across the top, and the green bars show absorption. So if you think back on 2009 and remember the pain, it felt horrible. People said, are we repeating the 80s? I have to tell you, it was so shocking to me to see that in 2009, we had negative absorption, but only a third of what we experienced in 2003. So it's really statistically not that bad. And I have to tell you, I entered this business after the 80s, and I remember what my mentors looked like. They look tired, they look worn out, and you guys look pretty good. So I think we all just need to move on. Okay, so absorption in 07 and 08, there was a lot to talk about. 09 was bad. You've seen different statistics. Our source is Delta Associates, one of our affiliate companies, and Delta looks at all user-occupied buildings, not just multi-tenant buildings, so that's the variance in the statistics. Year-to-date, 97,000 square feet, positive absorption. That is good. But it's interesting if you break it down by class. You see that, and you'll hear people brag about the Class A office market realized over 500,000 square feet of positive absorption in the third quarter, but is down for the year by 256,000. So all this flight to quality for the Class A office market, maybe it's happening, maybe it's not. I think what's interesting is there may be more of a flight to prudency in the Class C sector, because you can see it has consistent growth there. So it depends on how important office space is to the image and growth of your company. If you can tie nice quality space to revenue, then go pay the freight. And there's still freight to be paid because the rates just simply haven't fallen the way we thought that they would. Now, if you're a landlord and I'm negotiating a renewal, I'm going to tell you a different story. Okay, so this graph shows that rates simply haven't fallen like we thought they would. We saw a bigger dip candidly in 03. So here again, it's a building by building and market by market story. About 2.5 million square feet under development, 50% pre-lease. That's a healthy story. Vacancy is not as bad as it could be. And I think this graph going back to the early 80s just tells us what happens when you put, when you don't overbuild. That's really what we're seeing here is that we're not overbuilt. We've had a dip in vacancy, but not a big deal. Okay, a lot going on this slide. You can look it up later. Let me give you the highlights. The left column is simply a stack up of our 7 office submarkets by size. CBD is the largest, obviously, going down to Greenway. But if you look at how these guys stack up on vacancy rate, it's not surprising that the Northwest market has almost 20% vacancy. They had a lot of development. Okay, but in Greens Point at 14%, et cetera, it goes down. But in that second column kind of makes our larger office markets look like they are in good position until you look at the aggregate space that's available in those markets, and you see that the CBD and the West Loop have a lot of space. 5.2 million square feet available in CBD, 3.6 in the West Loop Galleria area. And I think it's intriguing that Class A rates in the CBD are still the highest in the market. Now, I'm really stepping out there and making a rate forecast. And if I'm invited back again in the future, I can eat these words or, glory in them. But I believe that most of the rates across our submarkets are going to trend down, some more significantly than others. West Chase, however, supply has been under control. It's a great place to be. City's growing west. I think the rates are going to stabilize, even though they've had a nice run up over the last 9 years. Okay, so what I've done in this last little segment, and this will take probably 2 minutes, and then you can all go back to making money. What I've done is I've taken the Class A buildings as defined by me. Okay, so you're not going to find these stats anywhere else. Class A buildings, when a client comes to me and says, we have to be in a Class A quality building in a submarket, I say, here's your set of 29 buildings in the CBD, for example. So I'm studying the Class A set that I believe is relevant. Okay, so if you look at the downtown market, you can say in this Class A set, there's only 7% vacancy. It looks really strong. Well, there's kind of an undercurrent that we've heard about and we kind of don't want to talk about, but we'll look at them in the next slide. Before I go there, notice that the downtown Class A segment has had negative absorption, 600,000 square feet. And we know we've got a new building coming online. There's been a lot of hype and excitement about, KPMG signed. They were the first tenant to anchor Main Place, and then BG just signed. That building still has 690,000 square feet hitting the market next year. That is not included in my vacancy or absorption numbers. Okay, take a look at the run of time between 2001 and 2009 and the rise in rates. And the rise in the downtown market it's a $6 rise. Is that sustainable? The answer is no. And we've already seen a little bit of a correction in 2010. I think we're going to see more of a correction, and here's why. If you look at what's coming available as an absolute, and then you look at the wild card players and you add up all the square footage, there's 3 million square feet potentially in play. Half of it's confirmed. 3 million square feet potentially in play. That means that 7% vacancy could very easily go down to an 18% vacancy in the Class A market. Therefore, I think rents have to trend downward downtown.